best in radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And welcome. You are listening to the Financial Survival Network. It's Kerry, Lutz. The date is Monday, April 13th, 2015. Time for John Rubino. And John, lots happening here. Gold up in every currency except the USD, and China exports way down, which is bad news for the world economy, isn't it?
Yeah, so especially the Chinese thing. But we might as well start with gold because that's a really interesting, almost theoretical kind of story. And basically it's that flexible exchange rates, in other words, where currencies are free to go up and down against each other, really distort your perception of the outside world. You know, you see the world through the lens of your own currency. And here in the U.S., where the dollar has just rocketed in the last year, when you look at gold, especially, which is a competing form of money and something that when it goes up, that's saying the dollar goes down and vice versa. Gold is in a really nasty bear market. Because in dollar terms, it's been going down. But if you look at the rest of the world, gold is actually up in local currencies pretty much everywhere else. In Canadian dollars, gold is up almost 10% in the last 6 months. And British pounds, 8%. And in euros, 17% in just the last 6 months. You annualize these numbers and you get major double-digit gains in the price of gold. In other words, gold is back in a bull market for most of the world. But here in the U.S., we don't see that because the dollar is up more than gold is up. And what that means is that we in the U.S. have a distorted picture of the economic situation in the rest of the world. Actually, out there, where currencies in general, other than the U.S. dollar, are going down in value, gold is rising. So in other words, gold is fulfilling its function as the reciprocal of your national currency, something that holds its value over time. So when your currency goes down, gold goes up to protect your purchasing power. So the question then is, when does that reality for the rest of the world assert itself in the U.S. for Americans looking at the world through dollars? And that's when the strong dollar begins to really affect the U.S. economy. Right now, we're in corporate earnings season. And if corporate earnings come in disappointingly, in other words, if American companies are having trouble selling stuff overseas because they've got to price their stuff in dollars, and that means the prices that they're having to quote are up by 25 or 30% in the last year, and therefore they're selling less, and that hurts their earnings and especially their sales, then it's going to be clear that the dollar is causing a slowdown in the U.S., and we can't afford a slowdown. We owe so much money that it's impossible for us to safely go through another recession because you just don't know what's going to happen when you owe debts at a level that we now owe. So the government is absolutely terrified of any kind of a slowdown, especially one that involves equities bear market. And so they will do whatever it takes to keep the economy from slowing down because a recession is possibly a near-death experience for us now. The 2008-2009 thing, when it happened, just about destroyed the global financial system. We were a couple of days away from martial law in the U.S., according to the big banks, which was the threat they used to get the government to bail them out. And in the ensuing 5 years, the world has taken on $57 trillion of new debt, ramped up the big bank derivatives books, and basically expanded liabilities in every other sphere of the global economy. We're much more highly leveraged now than we were then, so we're at even greater risk of a debt implosion if there's some kind of a recession. So we can't let that happen. We can't let the strong dollar push us back into recession. And if corporate earnings fall, that's one of the causes of a recession. If corporations make less and less money over the period of a couple of years, they hire fewer people, they scale back on their investing, and they scale back their stock repurchase plans. Equities go down, people feel less rich, they get laid off on their corporate jobs, and you see the economy drop into recession. Well, we can't have that. So if the dollar is causing a corporate earnings recession, then we have to do something about that. And so we will see the whole, we're going to raise interest rates meme that is now dominant in Fed talking head opinions out there. We'll see that walked back. And then when that doesn't work, we'll see a new QE program or some other kind of liquefaction that's aimed at devaluing the dollar in 2016. And so right now, the thing to watch, that is the beginning part of that scenario, is corporate earnings. They're going to come out in the next couple of weeks, beginning today with a fairly long list of companies that are going to report either during the day or after the markets close. And if they're disappointing, then that starts the ball rolling. All this stuff will happen.
Well, you know what? They'll come up with a new FASB ruling called the mark to most preferable for the market, mark to most favorable. Right?
Well, Alcoa, which is the early announcer among major U.S. corporations, already did that. They announced sales that were down because it's hard to manipulate your revenues, and earnings that beat expectations. But if you dig into their report, you find that about 2/3 of their earnings were one-time things where they took a write-off and then pulled that back out of earnings, and in that way were able to raise their net profit. Well, you can't do that year after year after year, quarter after quarter, and that's what they're doing. They're doing all this manipulation that is getting bigger and bigger on a quarterly basis, by the way, until it's now 2/3 of their earnings. And other companies are borrowing money and buying back lots of their shares on the open market, which lowers the denominator in the earnings per share figure that they come out with. So they might report lower earnings, but spread out over fewer shares. So the EPS number goes up. And that's another form of financial engineering, which distorts the true picture of a company's health. And so we're seeing that everywhere. That's a big part of the last couple of years, EPS growth in the U.S. Multinational sector. And we'll see that again here. We're seeing, for instance, General Electric just announced that it was going to sell off the real estate assets of GE Capital, which is probably a smart move. They're getting out at the top, but they're going to use a lot of the proceeds of that to buy back shares, which will make their earnings go up on a per share basis and make their management look smart, but they won't actually be earning any more money.
They'll be earning less.
Yes, because they've sold off an important division. Yeah. And so the cash that they have isn't earning anything. So to the extent that their real estate portfolio was profitable, they lose that profit. So their net earnings will go down, other things being equal, but their earnings per share will go up. And that's the number that the markets will focus on, because the markets need good numbers. They'll take whatever number out there can be spun in a positive way, and they'll run with it. And so that's why GE stock is way up now. And so you're going to see that across the corporate sector.
But
the question is, totally.
It really is a complete fraud.
It's unsustainable is what it is. You can do that for a while, borrow money or sell assets and then use the proceeds to buy back stock. But at some point, you either have borrowed too much money and you become unstable, or you've sold off too many assets and you become unprofitable, or you run out of shares to buy back. So these things have a limited time frame in which they can work. And I think we're getting close to that, because we've seen 2 years of phenomenal share buybacks, just absolute record levels of share buyback. And that's taking a lot of equity off the market and leveraging these corporations to the hilt here. So sometime in the next few months or few years, the general trend has to stop, just because they're reaching limitations in each one of the things that we're talking about. They're either too highly leveraged, or they run out of shares, or whatever. It can't go on forever. And when it stops, then they have to report more honest earnings. And those are going to be ugly numbers.
Yes, they are. And it's going to be a big wake-up call for the market. They're not going to like it one bit. And will that be the long-awaited correction for the market, do you think?
Oh, who knows? There's so many cross currents right now. Right now, as we talked about, share buybacks are a huge tailwind for stock prices, because that's an awful lot of corporate money coming in and buying back shares. You've got central banks around the world buying equities right now as a public policy tool, trying to push up share prices in order to make people feel richer, in order to get them to spend more money and then grow the economy that way. Of course, that's never worked. and it's being done on a scale that's never been tried before. So the Keynesians, who basically are the dominant economic school of thought that's running things right now, say, well, that's the problem. We didn't try it on a big enough scale in the past. So if we go really big, if we do trillions instead of billions, then this will work. And so we're going to find out pretty soon. But I suspect that trillions instead of billions just means a bigger mistake and more serious consequences after it doesn't work than a completely different world where government intervention on a vast scale actually makes markets work better. That's never, ever been the case. In all the industrial policies and other kinds of government manipulation of markets that have been tried over the last century, we have yet to have a success story. Yeah. And I don't think this is going to be.
This time will be different, right?
This time will be different. Yeah. There should be a lot of psychologists out there, psychiatrists, noting that that's the definition of insanity. You don't see it very often where they do this stuff over and over again, and people actually point out that it's never worked and that what's wrong with you that you think it will work next. You don't really see that in public discussion, but I think we'll see it in retrospect when the media will catch on and do a post-mortem on this bubble after it bursts and say, oh, yeah, they tried this like 3 times in a row and they tried it again and they sucked us in. Why didn't we figure it out at the time?
Dr. Johnson, what he said about second marriages, the triumph of hope over experience, right?
Yeah. And you could say exactly that with financial bubbles, only
and
this
financial engineering, right?
Yeah. This isn't the second one. This is like the 10th that we've tried. And
it never
all
works.
The others ended badly. Yeah. I mean, why is this different from the junk bond bubble of the 1980s or the tech stock bubble of the 1990s or the housing bubble of the 2000s? It's basically the same thing, only on a much bigger scale. And those things, those previous bubbles, ended with progressively bigger busts. So you got to figure this will be the same. And it's just a question of timing. And
the biggest of the biggest, right?
Yeah. And so we're looking for catalysts now. What's the thing that's going to burst the bubble? And will it be corporate earnings this time around? Will it be the effect of an extremely strong dollar on the U.S. and China, which is another interesting story? China's exports were reported over the weekend. And the consensus among economists is that it would come in at an 8.2% gain. In other words, they would export more in that month than the previous month. And instead, it was a 14.6% decline in exports.
That's a big gap. That's 20 some odd percent.
That is a huge miss. You don't see that kind of a miss very often. And once again, the triumph of hope over experience. Because China pegs its currency to the dollar. The dollar has gone up by 25% on a trade-weighted basis in the last year. And that means China's currency has appreciated dramatically, which means Chinese stuff has gone up in price on global markets. They price their stuff in yuan, and the yuan has appreciated. And so their selling prices have gone up. Well, you would normally expect, basic economics 101, supply and demand, that if the price of something goes up, people will buy less of it. And lo and behold, people bought less Chinese stuff in the last month. And economists, for some reason, didn't get this, even with all the other stuff that's going on out there. Japanese growth is kind of flatlining, and Europe is up a little bit, but not much. And the U.S. is seeing declining manufacturing statistics and they have for the last few months. So all of that added together would imply declining demand for Chinese exports. But who knows? We'll see what the spin is on this, because this is a brand new number that just came out. So we haven't seen a post-mortem yet where they dig into it and come up with a reason why it's actually okay.
Oh, it's fine. Unless you're running a Chinese factory. So the peg is going to get broken. Just a question of when, but it has to happen, right?
Well, again, this is what always happens in a currency war. You let your currency go up for a while, and because your trading partners are pushing down the value of their currency. So which is say you're losing the currency war at the moment, but that hurts you, makes it harder to sell stuff overseas. Your economy slows down. The political pressure to do something about this grows until you find you have no choice but to devalue your own currency. Well, the U.S. and China are in that boat right now. They're both seeing declining numbers relating to global trade. and to manufacturing. And that's putting pressure on the overall economy. Neither one of these guys can sustain a recession right now because China borrowed something like $15 trillion over the last 5 years in order to do a huge infrastructure build out.
That's what we know of. And there's
that we know of. They've got a lot of local and regional entities that borrowed a lot of money that seems to be off the books. But a lot of that didn't work for them. And now their economy is slowing down at an accelerating rate that is probably intolerable, that continues much longer. And so they have to do something. So the only thing they have left to do is some kind of stimulus. And the ultimate aim of their stimulus will be to lower the value of their currency. And the U.S. is in basically the same boat. We had pretty good labor numbers on the surface for about 6 months there, where it looked like a lot of new jobs were being created. Now, a lot of critics responded to that with the observation that, lots of jobs are being created, but they're mostly in McDonald's and the corporate temp jobs and stuff like that.
Bartenders, right.
Yeah, which those aren't actually real jobs, except for the handful of people who are professional waiters and professional bartenders. That's a fairly small segment of society. Most people pass through jobs like that on the way to a job in their real career, but we're not seeing people pass through. They're just kind of piling up in those sectors. And so that was a distortion in the reporting of our most important economic statistic there for a long time. And then it fell out of bed too. The last month showed a dramatic underperformance of hiring. And then they went back and they revised the previous 2 months lower too. So the U.S. economy is not looking nearly as robust as you would have thought from just the headline hiring numbers of the past 6 months. And you can trace that back in part to the dollar too. When your currency goes way up in value, not only is it harder to sell stuff overseas, but it's harder to pay back existing debts because you're paying those debts back in appreciated currency. You're having to get actually more real wealth in order to throw the stated amount against your loans. And so your economy slows down. No surprise, nothing mysterious about this. It's basic economics 101, basic supply and demand. And yet it seems to be a surprise to a lot of people. And so as these numbers come out and they're less and less impressive over time, the pressure is going to grow on us to do something too. And so we will have to, especially if China goes first, and they lower the value of the yuan, then that just leaves us all alone out there, just the U.S. and Switzerland with strong currencies. Yeah. And that can't go on for much longer. And so the coming year is going to see a reversal in a lot of people's economic and financial policies, with the U.S. at some point in the lead. The dollar can only go up a little bit from here before the pain becomes intolerable, and then we'll have to change our policy. So get ready for those headlines and get ready for the inevitable result of that, which will be possibly another leg up in the equities bull market, unless it's short-circuited by a crash because of bad corporate earnings here, and also gold finally rising in U.S. dollars. If we force the value of the dollar down, then gold, which just sits there, it doesn't really fluctuate. It's currencies that you denominate gold in doing the fluctuating. So if the dollar goes down, we'll see a gold bull market resume here in the U.S. And the timing of this is, of course, impossible to predict, but this is the kind of dynamic that we're likely to see in the year ahead.
Yeah, doesn't sound too pretty, and that could well explain why the next phase of the crisis is seemingly coming up upon us very quickly, and it doesn't look like there's anything that any one person or one country can do to stop it, does there?
Well, now this is a global currency war that's going on, which is precipitated by a global debt binge. Basically, all the developing or the developed countries borrowed excessive amounts of money over the past 30 or 40 years because we could. We had fiat currencies that people trusted, which meant that we had unlimited credit cards that we could max out. We could borrow as much money as we wanted to and create as much new currency electronically or physically and put it out there into the market. And people would accept those currencies as something of actual value because they trusted us. The world has trusted the governments running the major currencies. And that trust has been misplaced. And we're finding that out, or we will find that out in the not too distant future. And then all hell breaks loose. But again, timing, Kerry, who knows? It's been going on for much longer than it should have been able to. There's no way that we should have, as a global economy, been able to run up these kinds of debt numbers. Should Japan have 220% to GDP government debt? Should the U.S. have 350 or 400% to GDP total debt? These numbers are historically so unprecedented that I think an economist 20 years ago would have said they were impossible. And yet here we are. So if we're at an impossible place right now, there's no reason why things can't get even more impossible. Right. Because we have to redefine what's possible. And so I think one of the dominant ideas out there now that has taken hold, and I hear this from people every once in a while, is that, well, you know what? If this stuff shouldn't have been able to happen, maybe that's because the world has come together. The guys running these currencies have come together and just decided not to call time out. They're just going to let the system go on as it is and maintain it as it is. They have these unlimited printing presses, and they have the ability to keep the global financial system on this track for as long as they want to. And that sounds a little seductive at first glance, but until you remember that that's actually the meme that takes hold at the very end of bubbles. When you lose all the fundamental justifications for it going on, because every historical valuation measure has been thrown out the window and surpassed by the markets, you fall back on, well, it'll keep going because the guys in charge want it to keep going. It's in their interest to do that, and they seem to have the power to maintain this illusion of prosperity for as long as they want to. So why would it end if it's in their interest to keep it going? And of course, it always does end because they don't have the power to keep it going forever. Eventually, fundamentals win out. And so now it's a question of which branch of the insane global financial market is going to blow up in order to bring down the whole thing. And there's so many possibilities right now that it's a whole show for you and me, a whole half hour just to go through the potential black swans, potential catalysts that are out there. So there's no way to know which one it'll be, but so many things are out of whack right now. Yeah,
they're
coming. Government debts, corporate. Yeah.
You can be sure they're coming. Anyway, find more of John's work on dollarcollapse.com. And as always, you'll find the link in the show notes to this interview on financialsurvivalnetwork.com. John, we will talk to you next week. Be well.
Great. Thanks, Kerry. You too.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.